What is the classroom experience when I take the Canadian Investors course? We're going to cover a small piece of a particular class, dealing not just with mutual funds, but the whole idea of being tactical when approaching investments. We're going to talk about some particular funds that are very, very popular today, and we're going to talk about what could happen if things go wrong. The most popular mutual funds investors are buying today are balanced funds, income and growth funds, dividend funds, and monthly income funds. Balanced funds typically over the long term, and I'm talking over a 5 or 10 year period, tend to be 60% stocks and about 40% bonds or fixed income. Growth and income or income and growth funds are the opposite, about 60% bonds to 40% stocks. Dividend funds typically are stocks. However, they tend to be stocks that pay higher dividends. And in Canada, they're populated mostly with banks and utilities, and they tend to be dominated by stocks that are interest sensitive. So what is meant by interest sensitive investments? This is a bit of a review from lesson 1 and 2 in the bond market. Now here is a 100-month chart of Canadian 10-year bond yields, Government of Canada bonds. You could see how interest rates fell dramatically after that financial crisis in 2008. We've had all around the world, Americans dropped their rates, we dropped our rates, and as a result, there were tremendous capital gains that were earned in bonds. And you can see this bond fund is the exact mirror image of that particular previous chart. Interest rates go down, bond prices go up. So investors that participated in these funds gained interest and capital gains. Here's a longer period of time. Here's a period where you had actually interest rates or 10-year bond yields go down and then up. So this is the 1982 to 1991 area. You could see here in 84 how rates, they were almost at 15%, and they fell all the way down to the 8% area in 1987, and then back up again. And look at the bond. That same bond fund went up when rates were falling, and then proceeded to fall in value when rates were going up. So imagine owning this bond fund and slowly watching your fund lose value year after year for about 4 or 5 years. This is an interest-sensitive stock, a utility, TransAlta Utilities. Again, that same period of time. You know, interest rates went down, TransAlta price went up. In fact, you made about a 40 or 50% return on this stock between capital gains and dividends during that period. And then when interest rates went back up from 87 to 91, you lost up to 30-35% of your money. Now here's a tremendous chart going all the way to the early 1900s. Now this is a U.S. 10-year bond chart, 10-year bond yield chart, should I say. And our rates are very similar to theirs. We follow their patterns step by step. But look at this tremendous spike where I'm circling here, where interest rates got as high as that 15% number back in 1981. And that was during that period in the 70s when they were trying to crush inflation, which they eventually accomplished. And as a result, a recession occurred, and then interest rates started falling. We had the best bond market in history. Interest rates has continuously been falling since 1981. In fact, you look at all asset classes, whether it's stocks or real estate or precious metals, bonds by far have been the #1 investment over the last 25 years. Now these rates here, and I'm circling down at the bottom, this is where we are today. And if you go all the way back, rates are actually below what they were during the deflationary 1930s depression. These are the lowest rates ever. So you have to ask yourself, should I be buying a bond fund or an interest-sensitive type fund right now? If what makes it go up are falling interest rates, are interest rates really going to fall that much more? I I mean, theoretically, we can go all the way down to close to 0% on 10-year bonds, but we're already running below inflation. It's highly unlikely. It's probably a lot more risk going the other way. So is a balanced fund a good investment? Well, let's look at here. Let's look at these funds. Canadians love balanced funds. They have been the #1 fund up until about a year or two ago. Typical balanced funds are mandated, as we said before, they tend to be 60% stocks, 40% fixed income. So should I buy a balanced fund today going forward based on what's already happened? Well, let's make some assumptions here. Let's assume that the stock market over the next 10 years earns 7% a year, and this is a very generous assumption. As far as the bond portion of this particular portfolio or fund, yields are about 2% today, and that's the assumption we should be using. So, follow these calculations. So here's the balanced fund, 60% stocks. We're assuming 7% a year. We multiply that out. So that portion of the portfolio will return 4.2% per year. On the bond side, 40%, it's returning 2% a year. So we're going to be assuming about a 0.8% per year return on that portion of the portfolio. So when you add that all up, based on that 7% per year assumption, total anticipated return per year on this balanced fund or portfolio is about 5% a year. So is 5% a year for 10 years a good rate of return in a balanced fund? The answer is no. Mutual funds charge internal fees, management expense ratios, or the acronym MER. Remember, don't ask for the management fees, ask what's the management expense ratio. Mutual funds charge internal fees, which we all know. The MER of a typical balanced fund can be about 2.25% per year. Many funds charge higher than that. So let's take that 5% assumption. Okay. Now we have to remove 2.25% per year MER, and we end up with a 2.75% net return per year. And that's with market risk. In this case, the MER has robbed 40% of returns every single year. It does not pay to take this risk. So know what makes up a fund. Ask for investment guidelines and parameters. An income and growth fund would earn much less in our scenario. The other fund that we didn't talk about just yet is what's very controversial today, and that's the monthly income fund. Monthly income funds are being bought by many investors these days, and they're all being touted as, and you may have seen the writing, they're going to pay you 5 or 6% a year. Well, where are they getting that 5 or 6% per year? If bonds are yielding 2%, and you've got at least a minimum 1 to 1.25% fee per year, where are they making that money? Well, in the last 3 or 4 years, we had a big drop in interest rates, so it came from capital gains. So that income has to come from interest and capital. Well, if interest rates are going sideways or up, you're either going to stay the same capital-wise or you're going to lose money. So guess what? 50% of your income is going to be fees, and you're going to be stuck with 1 to 1.5% a year. And if they're paying you 4, 5, or 6% a year, you're going to lose your capital. Dividend funds, which typically contain interest-sensitive stocks, historically struggle when interest rates on bonds are not in a falling environment. So why are over 80% of mutual funds invested in interest-sensitive investments? Human nature. Mutual fund investors typically buy funds that have had good recent returns. Mutual fund salespeople, financial planners, or bankers recommend what has just recently gone up over the last 2 or 3 years. No one recommends a fund that fell for the previous year. In 1989, everyone bought real estate funds before the real estate crash of 1990-96. In 1999-2000, high-tech funds were the rage before the tech bubble crashed. You never got your money back after that. So what's the bubble today? Well, it seems that the bubble today could be a debt or interest rate bubble. So ask yourself, as an investor, as an educated investor, how much lower are interest rates really going to go? In other words, are interest rates in the future never going to go up? In fact, we may be at a point here where we may see for our lifetime the lowest interest rates, which means if I buy a bond fund today, I may never get my money back. This concludes this particular lecture. This is what's typical. This is the type of education you're going to get from this course. We basically explain exactly how certain instruments work, whether it's bonds or stocks or mutual funds or exchange traded funds, ETFs, and we talk about what could go good, what can cause them to go up, and actually where it's possible to lose money. It's very, very important that our students know exactly what they're going into, and we'll explain the good and the bad and the ugly. So thanks for listening. I hope you take the course.